Welcome, welcome, welcome. Welcome to Crashes and Taxes. I am your host for this podcast, Rebecca Walser. So excited to have you with us. Thank you to those of you that are giving us a 5-star rating on either Spotify or iTunes. We really appreciate that. And please go out and let us know that you like the podcast, and also tell your friends and your family. Today, I want to talk to you about commodities, and specifically gold and silver, as these are all the hot topics in this inflationary period that we're experiencing with this $8 trillion that the government has stimulated into the United States since March of last year. $8 trillion, where that comes from is CARES Act, $2 trillion, HEROES Act, a little under $2 trillion. Then we had the ARP that was passed in March of this past year. That was 1.9 trillion, so that's almost 6 trillion alone. And then you have the Federal Reserve currently buying $120 billion a month, 40 billion of mortgage-backed securities, and 80 billion of treasuries. So this is 1.3 trillion in 2021, and they did more stimulus last year when we were in the middle of the thick of the virus. So when the government, I need to explain something to you. There's something called MMT, Modern Monetary Theory. This new theory hails from Keynesian schools of economics that basically believe that you can print money indefinitely forever, and there will never be any repercussions as long as the interest rates are low enough to service the debt. You don't ever actually have to repay the principal. You just basically pay an interest-only loan, if you will, into perpetuity. Now, this is already disproven, in my professional opinion, this year, because we're already starting to see the rumblings of inflation. Core CPI, something they call core CPI, is a number that excludes volatile food and energy costs. So in other words, the government is judging how much inflation we have without looking at the two biggest sources of price increases to individual citizens of the country: food and gas, right? We pretty much are, with the exception of our urban areas, we pretty much are a suburb or a rural country. We have our main source of transportation as our automobile. So between gas and food, besides your rent or your mortgage and your transportation vehicle itself, these are usually the two biggest, expenses of an individual beyond their actual rent or mortgage. So for the government to discount those in assessing inflation is kind of counterintuitive and non-productive. So what we want to talk about today is gold and silver. We're hearing a lot of people calling into the practice and saying, should I buy gold? Should I buy silver? The answer is yes, you should. I believe in both of these commodities as a hedge. Specifically, I'm leaning more towards silver right now. I think gold is sort of over-bloated, but gold is extremely volatile. So I was literally just looking at a tracker on gold going back since 2000, and its peak was August of this past year, where it literally traded at 1967.60 and per ounce. That was its high, and we're now at 1729.40. So if you had rushed to move into gold literally between February and March of last year at the crash of the actual S&P, when the S&P crashed, which let's just look and see what the prices were February 1. So it went from 1564 February 1, and then it shot up through August to the 19 number I already gave you, 19, I'm doing this in tiny months. So literally the 1967.60 number, it shot up $400 an ounce during the actual coronavirus correction last year. It has since come back down to 1729.40. And that's where it's trading right now. So you can see the volatility. When the market drops, people move to gold. When the market starts to tear back up, people drop gold, move back. So it's really a short-term hedge asset for most people. I don't recommend necessarily using it in that capacity, but I would recommend having some gold and silver in your portfolio as a hedge at all times. However, that being said, I will tell you, in my book, Wealth Unbroken, which was published in 2018. Look, I sort of still look like this. On page 61, I have an actual copy of the executive order. And for those of you that are watching on the podcast, you'll be able to see it now. I'm going to read it to you, but for those of you that are looking at the podcast, you'll see me holding up my book, which has an actual copy of the executive order executed by FDR, literally, and the Secretary of the Treasury on back in 1933. So issued, and I want you to hear all the details of this executive order. Issued April 5, 1933, under executive order of the President. Issued April 5, 1933. I want you to hear how fast this happened. This happened so fast. It was issued on April 5th, 1933, and on or before May 1st of the very next month. So you didn't even have 30 days to do what I'm about to read to you. Issued on April 5th, 1933, all persons are required to deliver on or before May 1st, 1933, all gold coin, gold bullion, and gold certificates now owned by them to a Federal Reserve branch, bank, or agency to any member bank of the Federal Reserve System. Executive order forbidding the hoarding of gold coin, gold bullion, and gold certificates. So this is an actual executive order signed by Franklin Delano Roosevelt in 1933, where U.S. citizens were required to turn in their gold. You have to understand this was in the middle of the Great Depression. We had runs on the banks and people were beginning to hoard gold. And back at that time, we had a gold-backed system. So we were on the gold as our reserve. And so basically the hoarding was a problem. And so FDR decided that we needed to capture all of the gold, literally, into the actual, the actual. So I'll just read to you from the actual book on page 60. The stock market and economic crashes of the Great Depression starting in 1929 collapsed our faith in paper money and caused multiple bank runs, including on the Federal Reserve Bank of New York in 1933. President FDR closed the banks in March of 1933 and issued Executive Order 6102, requiring all persons to deliver on or before May 1st, 1933, not even within 30 days later, all gold coin, gold bullion, and gold certificates to the Federal Reserve in exchange for $20.67 paper dollars per ounce. In other words, you will give in $20.67 per ounce of the gold that you turn in. On June 5th, 1933, so this is the very next month, very busy month, April, May, and June of 1933, Congress nullified the right of creditors to demand loan repayments in gold. They could no longer require gold. So not only did the executive order require that Americans turn in their gold, but Congress then subsequently immediately passed a law saying that creditors could no longer demand payment in gold, because that's what some of them were doing. They were no longer taking the Federal Reserve notes or the paper money, our dollar bills. And so, literally, and I love this paragraph. I'm going to read this to you. It's my own book, my own writing. It's kind of interesting. The President's executive order requiring privately held gold to be turned into the Federal Reserve in exchange for paper money, along with the Gold Reserve Act of 1934, which fixed the price of gold at $35 per ounce, led many other nations to transfer their gold to America, making the United States the sole country with the largest gold reserves in the world, a status that it still retains to this day. So I bring this up to tell you that even though you can go out and you can buy gold and you can buy silver, and they are good commodity hedges for sure, they cannot and will not be the end-all be-all, because we have precedent when things go wrong that the federal government can say, turn in your gold. It's happened before. It could happen again. And so you cannot rely on gold as the end-all be-all like people think that you can. The other problem I'll give you is a really legitimate problem that's happening right now in Venezuela. So, as you know, inflation is so bad in Venezuela that the amount of currency you have to take in is wheelbarrows of cash to go in and literally get a shopping cart full of groceries. And so when you have gold, let's say that you have a small gold bar, and it's worth, I don't know, let's say $3,000 US dollars. I'm just making this up. I'm just taking the price per ounce of $17.29 and saying, okay, let's say we have 2 ounces in a little gold, bar. we have about $3,400 worth of gold, US dollars worth of gold. And we go in, this has already happened in the United States, by the way, but right now I'm talking about Venezuela. In Venezuela, you go in with your $3,400 worth of US gold, and you want to buy milk, bread, you want to buy the basic necessities of food for your family. Everything is rationed and there's no change. So you go up, you can't buy more than 2 breads, you can't buy more than 2 milks, you can't buy more than 2 of anything because everything is rationed. And the store doesn't have the ability to give you enough change for your gold bars because everything in paper money takes wheelbarrows and wheelbarrows. So you go in, you're rationed on what you can buy, and they can't give you the change that you need in their paper money because it's so worthless. So you tell me how using gold and taking gold to the store to buy things is really going to work out if it's not transactable or fungible, changeable into value, giving you change. This has happened in the United States, not exactly in the same way, but for example, I went into Target just a month ago and was so happy to see an entire shelf full of paper towels and toilet paper. Like I wanted to squeeze the packages of it. I was so glad to see it. Yet big, huge signs everywhere. And this is just this year. Like this is still in my Target locally what's happening. Limit 2 per customer. Already limiting and rationing what we can buy here in the States when a global calamity comes upon us. I'm sure this shipping that has just been unblocked in the Suez Canal and has blocked up the global shipping lane there, which is so important, is going to impact prices and give us more inflationary pressure. We'll see that worked out, but I think they thought that was going to be a lot bigger than it was, and it ends up not being. So the point I'm trying to make is, yes, you should have gold. Silver especially, I feel silver is definitely going to have a good trajectory of a run-up. I like both, but it is not the end-all be-all. It is not the salvation of the world. We've had our own president tell us before to turn it in. We have had rationing. We have had the inability to buy what we need when we have gold. So you have to understand that things aren't as simple as, yeah, I've got all kinds of gold, I'm going to be fine. It's about transacting business with the opportunity still to make what you need happen with that gold bar, and will it really work out? And those are things to think about. So gold is very volatile, high and low, and definitely on a long-term basis, gold will go up over time. And the more inflation we have in America with all of this stimulus, with this new infrastructure package that this administration is now talking about, $2 trillion infrastructure package, of which only 25% actually is earmarked for roads and bridges. But when you spend another $2 trillion, you're getting our total closer to $10 trillion in a year's worth of time, maybe 2 years by the time it's all said and done. And you have to understand, $10 trillion over 2 years versus 28 trillion since 1776. We have some problems ahead, and we need to prepare for them. But gold and silver is only a tool. It is not the solution. Hope you're doing great. Until next time, my friends, enjoy your week.